Hey guys, Mr. Gibson here. I'm going to show you all in this video how exchange rates affect monetary policy or vice versa. How monetary policy affects exchange rates and what the effect on net exports can be. Okay, so let's start out with our economy in a recession. Okay, so I have my long run aggregate supply curve here, have an aggregate demand line here, and a short run aggregate supply right here. Okay. We've got some sort of price level right here. And we've got an output that is below the potential output, meaning that we are in a situation where the economy is in a recession. Okay. So, as we've learned, the Federal Reserve will want to increase money supply in order to uh, increase money supply in order to uh, losing my train of thought. Sorry, you guys. Increase money supply so that the interest rates will go down. We'll do this over here. And as interest rates fall, that will spur investment spending, or as we like to call it, interest sensitive spending. Okay, so interest rate falls. I'll put a little here due to uh, expansionary monetary policy. MP. Okay. So, of course, our little story interest rate goes down, which makes interest sensitive spending go up or investment spending to go up. And as investment spending goes up, our GDP goes up, which is wonderful. That's exactly what we want to happen. Now let's see how how this will affect the exchange rate, and likewise how this will affect um, um, and likewise why. Just figuring something out here, guys. Sorry about that. And likewise, why the exchange rate, pardon me, uh, and how the exchange rate will affect the economy. Sorry about that. I'm losing my train of thought, but bear with me. All right. So as interest rates fall, okay, it'll affect real interest rates because all else equal, real interest rates will fall. That's also why investment spending goes up because we're talking about real interest rates. And what that's going to that's going to cause is a capital outflow, right? Because presumably there'll be other countries out there with lower interest rates since our interest rate just fell that investors will go, or savers, they'll take their savings, or investors in that case will then take their savings, go to another country, and um, put their capital into that country, into different bonds or stocks or whatever you have in those countries because there's a higher rate of return. Okay. Well, if we remember from a former video, as you have a capital outflow, our exchange rate, well, look at what happens with it. So let's say we're United States. So, and let's look at euros per dollar. Okay. This is the quantity of dollars. This is the market, the exchange market for dollars. Demand, supply. So as people take their capital make a little E for exchange rate. So people take their capital and go to other countries, European countries, presumably, to put their capital in that country, to take their savings and put their savings in that country. Uh, they'll have to exchange their dollars for that currency. They'll have to exchange their dollars for euros. Okay. Sorry, guys. Hit the exit button there. Bear with me while I redraw this. So again, we're in a overheated economy. I'm not going to label these because you guys know what they are. We're facing inflationary pressure. The Fed is addressing it by decreasing the money supply in what we call contractionary monetary policy. They conduct this contractionary monetary policy because that means interest rates will increase. As interest rates increase, interest sensitive spending, especially investment spending, falls and GDP falls. Okay. So here's the main point of this is let's talk about how this all is going to affect the exchange rate and net exports. Okay. So let's go on down here. So here is still trying to understand this, you guys. It's kind of interesting how some of it disappears and other parts of it doesn't. But anyway, I'll leave it alone. So this will cause an increased interest rate is going to cause capital inflow because presumably the rest of the world has lower interest rates and now our interest rates are higher. So uh, people can put their savings into this country and get a higher rate of return. So capital inflow. Because remember, again, high interest rates are not attractive to people that want to borrow money. But for people who are saving money or lending money, high interest rates are attractive. Okay. So that's basically what this is saying. So they want to take their savings, put it into this country. And as they do that, they're going to have to go. Again, let's use the dollar. Let's say it's Japanese investors because this happened a lot in the 80s. So we've got yen per dollar. Okay. And this did happen a lot in the 80s, actually, in the late 70s. Okay. We have some sort of starting exchange rate, and this will increase the demand for the dollar because people are wanting to go out and buy the dollar. And as they do that, the exchange rate goes up. Okay. The dollar appreciates, which makes goods and services in this country more expensive relative to other currencies. Exchange rate increases, or the exports increases. Net exports increase. No, excuse me, like it's more expensive, so exports go down. Geez, I'm sorry. So as the currency appreciates, goods and services in the United States are more expensive relative to the rest of the world, so people will buy less of US goods, meaning exports decrease, net exports decrease, and output decreases. But again, that helps the Fed out. That helps the Fed do their job because they wanted output to decrease to control some inflation. Okay. So the floating exchange rate becomes a very good tool for the Federal Reserve. Quick note too, whenever I say that if a currency appreciates and exports go down, presumably the the value of other currencies depreciate relative to the dollar. So that makes their goods and services appear uh, cheaper to us. So we go out there and we actually purchase more of their goods and services. So imports would actually go up too. But it's the same effect. Net exports go down and output go down. And I just wanted to give you guys a quick note on that, just so that I've said it because I've kind of focused more on exports, but the whatever affects exports negatively has an inverse effect on imports. They react inversely to each other, and the exchange rate and that's pretty intuitive that the exchange rate has these kind of um, reciprocal or inverted relationships with each other that as one as a currency appreciates relative to another currency that currency depreciates relative to the other currency. So in this case where the dollar's appreciating, the yen would depreciate. So anyway, I just want to make a quick note about that. It's either here than there. All right, thanks. Bye.